Let's do it. Yeah. So, as Noah said there, I think we have an interesting team here. We're diving in on how to grow and manage your storage portfolio, really trying to cover the entire workflow or investment cycle, so to speak, from cradle to grave by bringing in people that we think represent the different pieces of investment management well. So, Nathan, why don't you introduce yourself, because you're kind of tip of the spear on real estate investing here.
Thanks, Peter. And thanks again for having me. And no, always great to connect and join forces here. My name is Nathan Coe. I've been in the self-storage sector for over 10 years, all with Marcus Millichap. I help run the Hatcher Co group. We're a national team. Most of us are based in Columbus, Ohio. We sold storage in 43 states the last few years. We have 12 agents and a back office of 6. And we're experienced with any level of self-storage, from selling a large portfolio to a single asset, selling for public REITs, institutional groups, to mom and pop buyers and sellers, some development deals. So been able to really see all aspects, especially of the investment side and ownership side of our great industry. And looking forward to being part of the discussion today. And as always, around to help if anyone ever has any questions on what we're working on or seeing in the market. And yeah, thanks again for having me.
Yeah, of course. I know that on the various brokerage listings that are out there, I think Nathan's name's on like 1 out of 3. He knows
hopefully some of the closings as well, you see, for sure.
Yeah, exactly. Noah, would you go ahead and introduce yourself?
Sure. It's great to be here, Peter. Appreciate you and the White Label team for inviting us. I'm the CEO of Tracked IQ. We're a self-storage data platform to help investors, brokers, and operators find and analyze self-storage deals a lot faster. We're the official data provider for the Self-Storage Almanac, and we share a ton of amazing information and research around not just how the industry is doing, but what makes a good opportunity. I was previously an investor, but we're all in on building the best data company in the country. And I see Violet and Lisi and Trish and Dylan. Appreciate y'all commenting on the chat, because I'll start this off with a question when we get to the next, I guess, 2 slides from now, but encourage participation and really appreciate, Peter, you and the team having me on.
Yeah, of course. And I'm Peter Smythe, co-founder and CEO of White Label Storage and a company called Local Locker, which you can see behind me. We started out as really a retail self-storage installer in New York. We were converting space from unused retail space into small neighborhood walkable storage. Realized along the way that we built this core competency of running self-storage facilities, developed some tech, and out of that we spun up White Label Storage because we saw there was a need in a very fragmented market across the country to provide a national managed services platform to help people run their stores at an institutional level. I will be speaking on behalf of the management piece of this, so closer to the grave than the cradle on these deals. But yeah, like Noah said, I think we're open to questions throughout. We're going to be running through a presentation here, but we'll be talking with each other throughout. We think that's the most effective way to run these webinars. And so please do chime in either on the Q&A or the chat. So with that, why don't we dive in here? And start with prospecting. We're at the top of the funnel here. We happen to have an expert on the platform. Talk to us.
I'll even just say I think we have two experts in this case. So
I don't know. Do you start with the data or the people first? Who's going to?
Yeah, I would say the way that Nathan and I can tag team this section here. So I think just to give a little order of operations, there's a prospecting playbook that we put together, and Nathan's obviously contributed, and we've learned a lot from him and his team. But we have a prospecting playbook to kind of walk through how, if you're looking for off-market storage deals, or if you're looking and trying to understand which of Nathan's deals, which all of them, but which of those are the ones that fit your goals and investment criteria, like how to think about that. And then since we have Nathan, who's actively doing all of this every day, as are we with our clients, we can kind of go back and forth on some of the best practices that Nathan is seeing. And then Peter, of course, you can chime in. We'll keep it conversational.
Yeah. And then there at some point there will be some thought that you need to put into how you're going to run these things if you do happen to catch the car. So
I have a question for the chat, and maybe it's for Nathan and Peter as well. How many active self-storage facilities are there in the United States? Peter and Nathan, can
I fire from the hip here?
Fire from the hip.
A couple years ago, everybody said 50,000, right? I have the sense that it's way closer to 70 than it is 50 if you're including boat and RV, just based on our data alone, because like we encounter so many facilities that very clearly aren't listed on whatever the data source is or has been traditionally. So I'm gonna say we're getting close to 70. I'm excited to actually hear the answer.
Yeah. And I see we've got a bunch of Alex at 50K, Edward said 58K, Aaron said 68K plus or minus, Lisi said 70K plus or minus. Nathan, any guesses before?
I was going to say 50 because that is the number I have heard. I think Peter brings a great point. There's types of properties that are similar but different. Boat and RV probably be the most glaring one. That's probably part of that count. But then there's this hybrid storage and flex space. There's high bay industrial. If you have 40 high bay industrial, is that a storage facility? So I'll say if you include some of these similar type properties, it's probably pushing 75K.
Okay. So let's take out boat and RV for a second. Thanks, okay. Tom. I'll tell you the answer after I ask a second question.
Oh, geez.
Right? How many self-storage opportunities are on the market on average? And Nathan should know generally correct, but I'll look at the chat. How many self-storage opportunities could you actually go and buy right now from a broker or a listed site?
Jeez.
And I'm setting up of why I think prospecting is really important and what the opportunity set is.
Yeah, I mean, not Nathan, is there more than, can there even be
3,200 from Dylan? I would say it's generally between 2,000 and 4,000 properties at any time could be on the market. And Nathan has his fair share of those as well. But I say that because there are about 65,000 active self-storage facilities that we are tracking, that we verified every single, that we're verifying with our data. So I think trying to paint the picture around like, what is the opportunity for prospecting, right? If you have only 2,000 to 4,000 properties, and you think about that, of the 2,000 to 4,000, which of these would you never buy? Like they're over 100,000 square feet. They're institutional Class A managed facilities, right? So your current opportunity set is actually pretty low if you're just looking for on-market deals. So this is where, as you think about building the prospecting engine, right, to find deals, and this is not just for investors and brokers, but even third-party management companies, right? Like how can you build a system where you have a repeatable funnel of potential opportunities? Right. So here, this is where, prospecting here, we put together a 5-step process here that we're going to go through. And then we have a couple of slides on how, what Nathan and what we're seeing in terms of how top investors are actually evaluating deals, like what data sets are they leveraging? And then we can get into buying it is only part of the story, right? You need to manage it well. And that's where Peter comes in. So step-by-step process here. First, actually identify your target market. The second is actually building up a database of prospects to reach out to, right? Whether it's phone calls, emails, mailers. The third, one of my favorites, is Nathan's awesome. There are a lot of great brokers out there. So making sure that they're hugely part of your process. The fourth is also kind of with Peter, right? And other great operators, right? Partnering with those, and then just being visible and curious. So I think we can go to the next slide and we'll dive into each one. And then for each of these slides, Nathan and Peter would love to get your take after I roll through the information here. So we talked at the top of the funnel, right? If there's 65,000 self-storage facilities across the country, right? There aren't 65,000 opportunities that you want to buy, right? You who are on this call, right? You might have certain criteria, like you want the facility to be between, 10,000 and 20,000 square feet. maybe you want it to be a non-REIT facility, right? You want it to be managed by someone that's owned it for 20 years that hasn't raised rents in a long time. Maybe you have some income thresholds or density thresholds. And we have some cool stats here from courtesy of the SSA demand study and some of our data that we can talk about. But really, you want to understand what your target markets are across the country, because 65,000 is a lot. So if you're saying I want to scattershot all of them, you're not going to stand out across the crowd. But Nathan, Peter, curious in terms of identifying markets, how y'all think about it.
Yeah, I'll chime in first. I mean, first off, I think the 5 stages and steps is perfect. And I mean, there's so much data out there. There's a lot that people don't utilize, which I think where Tract IQ comes into play. But there's so much that point is you can go crazy trying to be over analytical. I think if you can simplify it in the way you have, and then sort of what you're getting at to really identify a target market, it's still challenging, and some things we'll go into later than why it's challenging to buy for a lot of reasons. But I think if you're not starting off that way, you're almost wasting your time. If you're stretching yourself too thin, you're not making a name for yourself. If you're just trying to go all over, it's just really hard to really get focused and find something that may be a potential fit. So I agree 100%. It's very similar to how we're, as brokers, trying to run our business and not trying to get every listing or sell every property in the country, really try to own a market share or be able to create a name recognition and brand within a market. So I think that the way you simplified it is not only needed, but I think it's an easy way for someone to be able to really replicate that.
Yeah, I talk a little bit about this later, but I mean, I think one thing that I would layer on here that is maybe obvious, but you can identify a good deal in a vacuum, but being thoughtful about what your strategy is beyond that first deal, and just trying to think about what your playbook will be, whether you're managing it or your investors are willing to invest in different geographies. Like, once you determine your buy box, is it one that scales, and are you thinking about the limitations of the broader holistic play as your investment strategy as a whole versus a one-off asset?
100%. And this is relatable to any kind of company, right? If I want to buy a storage property, the first step is building your buy box, building your target market, so that you can focus in on and be really clear about what is the opportunity set, right? I think if you're just looking for sites in Texas with, there's only 7,000 facilities in Texas. And then if you want it to be within an hour drive of Austin, there are only so many opportunities. But as you narrow down your scope, that's how you can separate yourself as we get into some of these next steps. So I think we can go to the next step, which is one of my favorites and I'd really like to get Nathan's perspective here. So with Tract IQ or other services, right, you can build a custom prospect list of all the facilities that match your criteria and actually start outreaching, right? It's available today, right? And you can come talk to us. But one of the things that I feel like is really hard, especially in the age of Apple having spam blockers and owners getting phone calls consistently, how can you stand out, right? And I'll give you an example. Peter, if I or an associate of mine called you up and said, "Hey, Peter, or is this Peter?" And you'll say, "Yeah." You'll say,
Maybe.
Are you open to selling your facility? And you're gonna be like, "Who the hell is this?" Like, no, leave me alone. If you answer.
Yeah. And on top of that note, you've probably already got that call 20 times a week, right?
So the point being, it's not enough to have the right data and to get on the phone with the owner. But imagine if the conversation changes a little bit and Nathan is calling you, Peter, and he says something like, "Hey, Peter, I noticed that you own this facility in Austin. I actually have a listing 5 miles away from your location that just traded, or I think is about to trade at a 6 or a 7 cap rate. There's no new developments within 10 miles of your facility. There's a lot of new housing in the pipeline. And I think I could actually, add a lot of value. Do you want me to send you some of that information?" See how much different that is. And even if you're not a broker, right, and you don't have the great listings that teams like Nathan have, right, how can you, add value and differentiate yourself when you're talking to these owners.
Have you found that this is a chance, like as data is more available, have you found owners to be less receptive to the call? That's probably a question for Noah's dealing with that more than you are, or sorry, Nathan's dealing with that more than you are, probably Noah. But in terms of doing new business, like there are agentic sales development reps that could be out there, or even offshore folks in India that are just calling facilities around the block. I know I can think of 10 different guys with Twitter accounts that are doing that right now, and probably using platforms like Tracked IQ. What is the, has the reception changed over time, Nathan?
I believe it has, but I think there's still an opportunity, whether us as brokers or an owner, to build a relationship. I mean, it is a numbers game, and I can touch into that on just, in addition to everyone's day job or running their own facilities or whatever they're doing or family. I mean, it is very time consuming to do this right, like some of the steps that Noah outlined. But I think where there's still a huge opportunity is just being a person and developing a relationship. And just like us as brokers, you may not have that great conversation or positive sort of talking points that you can follow up on right away. It might be call 3 or 7 or 9. I think it's similar for anyone who's prospecting on their own. It may be a similar time constraint and hurdles to jump through, but there's still an opportunity to be like to establish credibility at a personal note. I mean, I've seen some really cool like personal letters that people have sent that are different than the text of "Will you sell your house all cash?" So I think people are inundated, and all of us are as well, with spam calls and everything. And even if I'm a broker with real information, you're still catching people on when they're not ready to be talking to, and they've gotten 8 calls in the last week that are similar. So there's more of that, and people have their guard up, which I probably do too when people call me that I don't know. But I think there's still, it sort of adds to the opportunity to become a person and develop a relationship and just be courteous and professional and follow up the right way.
Yeah, I'll piggyback onto Nathan's comments around the noise has increased. It has never been easier to send mass emails, mass texts, mass phone calls, mass postcards. It's still really hard to drive to your facility, take a selfie in front, and send it to the owner with a handwritten note saying, "Went to your property, really loved it. I would love to meet and get a coffee." Right? So the increase of the noise has increased. It's never been easier to reach out at scale, but I think a lot of people fall into the trap of scale instead of quality. And, at least in this playbook here that we're talking about, it's very much around like spend your time wisely, focus on things that if you got a hold of the owner, it's actually in your buy box. Like even that step in and of itself saves a lot of time for everyone and makes you more genuine. This one here, right? Taking someone out to lunch, things like that, especially on the next slide as we talk about brokers, but certainly a huge opportunity if you do it right.
Agreed.
This next one, I don't think Nathan likes this slide, so we're just going to skip it. No, I'm just kidding. This one here, I put in, there's a lot of data and a lot of ways that you can find off-market deals, but some of the best deals in the industry are done by brokers. And I think a lot of people have not learned properly how vital brokers are for real estate, how they don't get paid until the deal gets closed, how many questions, how much stuff they deal with between the owner and buyer, how many opportunities they underwrite and get under contract that don't close, how many lenders they deal with. There's so much here that makes that job really challenging. So a way to stand out is to treat them like partners. And, Nathan's a great example. He's got active opportunities as we speak. Is he more likely to want to transact with someone that doesn't treat him well and doesn't, communicate with empathy versus the person that does? Right. I'll let you respond to that, but that's at least my thoughts on this slide.
No, I mean, to piggyback that, I mean, it's, I think there's a time and place for the off-market deal. And if I'm advising someone to buy, it's like do everything you can to get to these people before they list, before they're talking to 5 other brokers. Maybe some of those are public REITs or institutional groups it's hard to compete with. So there's a lot to be said on I think in this market that's tighter. I mean, where you can really add value is not necessarily that big expansion deal or mom and pop site that has 20% below market rents. That's what everyone looks for, but it's to find a deal that's not on the market and you catch a person at the right time, and maybe you're buying it 20% below market, and right there you've added a lot of value. I think on the flip side, and a little bit to what Noah's talking about, us as brokers, or when you see a listed property, it's sort of through a certain stage of qualifying. Not critically, there's a lot of people that say they're open to an offer, or you may reach out directly and they say, yeah, I'd consider selling, and you spend hours underwriting and talking to a bank, and again, not critically, but then turns out they're only looking for a price that was only achievable or market 4 years ago when someone could get a 4% loan and the federal funds rate was 0, and we're in a different time. So what I'm getting at is I think brokers add a certain lot of sort of qualifying, where it doesn't mean everyone who's listed is definitely selling or needs to sell or overly motivated, but I think they're more motivated than others that aren't. So I think it helps to qualify real sellers. And again, that doesn't mean you still can't try to find that off-market seller that could be a good deal. It's just, it is harder to come by. So I think whether you're buying your first facility or your 20th facility, I think having those relationships with brokers, not only see the opportunities, because that's not hard. You can go on List Self Storage and many sites and see what's on the market pretty easily, but really having that dialogue with the broker and asking the right questions and really understanding, okay, I like this deal, but it isn't priced where I think it can make sense, but maybe it is worth digging in. And in those conversations and relationship with certain brokers, I think there's a lot of value in that, to be able to identify what's worth even spending your time on, what may not be, things like that.
When you're talking about somebody that's prospecting, buying a facility for the first time, and they're trying to build a relationship with you, are there a couple of quick hits that they can make sure they've done their homework on to have you kind of lend credibility to them as a potential buyer? Whether it's, hey, do you have capital? Like, are you going to tie a deal up without capital and then go try to find the capital? Like, show me your capital. Or do you have a track record in another industry? Like, are there a couple things that you think could be in their own little playbook of make sure you come ready to present this to a broker if you want to get them to show you some deals?
Absolutely. I think a lot of things you mentioned, like, hey, I am buying my first facility. There's no way around that, but this is what I've done. I've been looking at listings for 2 years now. I have this is my banking relationship, and I have pre-qualified for this. This is my equity partnership. So we are in the ability to move quickly on a transaction of this size. So be able to have that dialogue. I think a lot of people almost try to like talk more of a big game, and then it almost has the adverse effect when I'm talking to them, that they just like, yeah, I do deals all the time. I own a lot of real estate, and they don't really sort of answer the questions that some brokers will ask or won't even ask to just see how real they are, and sort of being blunt, like, hey, I know I don't own a facility yet, but I have been underwriting facilities for 18 months. I've underwritten 200 deals right now, and while I'm still looking for that first opportunity, I do have my debt and equity lined up. Here's some details. I'm happy to send it, and just being more like real with it versus, I think it's, especially in storage, it's very niche, and probably most industries, it's very easy to see who's just trying to like speak a big game and who's actually like understands what they're going up against and has done the right steps to take it there. And you can sort of sense pretty quickly how legitimate someone is, if this is someone who's just going to tell you what you want to hear, or that has really like put some thought and time and energy into the whole process here.
Well, that's back to you. I mean, to keep this thing moving, then that is back to you, Noah, of like, if you can be very specific about your buy box and your search criteria, then there's credibility right there alone.
Yeah, and it really just comes down to the word honest and transparent, right? And if you're honest with Nathan or the broker on the deal about, look, I have a W-2. I've been trying to break into storage for a year. I've underwritten all these deals, and this one checks a lot of boxes. I'm part of this mastermind community. I've got mentors, and I'm going to do my best to execute on this. Then that is credibility, right? Like you're coming across as a trusted person versus the flip side of, well, I've done multifamily, I've worked for this thing, I've got it all down, when in reality, you're going through your first deal. So it's really just being transparent. I think that helps a lot. And the next slide, I think, helps a lot too, right? Because it kind of potentially could come first, but I would make the case, if you're partnering with local operators, White Label being a local operator and with all the markets they're in, there's some other great operators out there, right? They'll help you underwrite the deal, right? So now you can come to Nathan and say, hey, look, I had White Label or had another management company underwrite the project with me. Here, I've shown this to a lender. The cash flow looks good. I think we can get a loan in this range, and it helps you kind of validate the underwriting, validate the opportunity, and also learn from their local market expertise, right? If White Label has facilities nearby the facility that you're acquiring, then maybe they can share some of that information with you so you can better underwrite the facility. So partnering with local and experienced operators, part of this process as well.
I agree 100%.
Yeah, I got nothing to add there other than make sure who you're partnering with, challenge their underwriting. Hopefully they'll challenge yours. We'll often say, look, this is too rosy of a picture that you've put together here. I mean, you want to have, this is back to honesty. You want to have honest conversations with people who will shoot you straight on what performance might look like.
Yep.
I think, we've already sort of said this, but I think that's sort of, you hit it on the head, is everyone has to start somewhere. So it's not like, sometimes I think when people do you own any facilities, that comes across as like a negative if you're a buyer, and you have to overcome that. But again, we understand as brokers that everyone we work with bought their first facility at some point, but there's a way to go about it. I won't share too many details. He might be on the call today, but there is a buyer I'm working with. We're closing this year. I believe it's his first facility. His name's Tony, and I think he just went about it the right way. He didn't say, hey, we'll buy anything, we'll buy all over. Like right away, you're like, all right, this person's not really going to be credible. He was a much more granular approach. Yeah, I grew up in this region. I'm looking only in these 3 states. This is my background. This is the conversations I've had with Live Oak and management. So he sort of did everything that we're saying, and he communicated well, and sort of right away you sort of know, like, okay, this person isn't just like any tire kicker that's just trying to say the right things and tie up deals and maybe buy 1 of 10. This person, I don't know this person from a few of our conversations, but you have a pretty good feel of, okay, this is someone who is credible, and he gets his due diligence. He'll still do due diligence, but I think just that like short dialogue over a few conversations is enough to go to a seller and be like, hey, this isn't the group that owns 20 properties, but this is who he is. This is how he went about it, and I think sellers appreciate that. And at the end of the day, if you're a broker or a seller picking a buyer, it's still a leap of faith, and nothing's guaranteed, even with bigger groups. But I think if you, as a buyer, can effectively communicate that and just be come across as a credible, genuine person, I think people will give you a shot. And
I'll give another example, Nathan. It's really about this slide, which I think is like, well, obviously you should be visible, curious, and add value. Like, obviously you should do that. But I'll give you an example. I have another broker friend who's just went under LOI with this buyer. First time buyer, never bought a storage facility before. The location is within an hour of his house. He's been part of a mastermind group community for a long period of time. He's gone to conferences, he's gone to trade shows, and he befriended this broker over a long period of time. And he actually is now under LOI on this deal that his terms weren't even as good as the other person, but the broker saw that this person was committed, was visible, was curious, was adding value, actually cares. And it kind of made the difference in the deal. So I wouldn't diminish or this slide in any way. It's like it's so easy to learn and to share information, but a lot of people don't. And I think that's a missed opportunity.
I agree.
I think these next couple of slides, I think we can maybe rip through them a little bit faster, just because I know we have got cap rate data, and then Peter, you've got a lot of information down the road. If that's cool with you.
Let's do it.
So I think top data sets investors are using, I mean, we work with groups as big as Public Storage and first-time buyers, right? So across the spectrum, but there's been a huge, I think, improvement in data, not just from us, but from other folks in self-storage. And I think as we've seen the challenges in self-storage over the last 3 years, where rental rates no longer make sense because there's web rates, there's street rates, there's achieve rates, no one knows what's going on. There's some other data sets that are available that we wanted to highlight here. So if you go to the next slide, we'll talk about housing. Yes. Okay. So tracking all the housing data, like I think we've all seen a lot of data around the correlation between housing sales or home sales coupled with housing deliveries and storage demand. And we have information on tracking all of these new housing projects that come into the market. So a couple of facts that I thought was really interesting here. The first is that almost a third of storage renters use storage just because they're changing residence, just because they're moving. And what signifies moving? New housing projects that are delivering in the area, right? If you have 1,000 units of an apartment complex delivering within a mile of this storage facility, over an 18-month period, how many are they going to get to 90% occupancy? Like what, if so, they're going to have 900 people moving in and around that facility, right? So that causes future storage demand. Second piece here, almost half of storage renters just use storage because they have no home or no room at their home. And then 72% of renters actually live in single family homes. So not just multifamily projects, but also residential subdivisions, what Lennar communities, what KB Homes, what Meritage Homes communities are coming into the area. All of that is really, really important to track, especially in this last tidbit. I don't think is widely known, but I think it's probably negative for America and society. But the average home size that's getting built is actually decreasing. So all of those things are really interesting storage demand things to consider.
Hey, we're being more efficient with space, man. That's less resources. We're creating suburbs and cities, and that's sustainable living. Come on, duh. You got to buy into small homes.
Hey, I think we can have an interesting, maybe not for this webinar, but another one. I think we could talk about that. But I think some of this is pretty standard. Understanding rates in a market has never been harder and has never been more important. I know Peter deals with this every day on the operation side, and I think you'll touch on this later in the presentation around, move-in rates versus street rates versus achieve rates. How to think about ECRIs, and I'll be on a panel next week in Austin talking about revenue management. So I'll save a lot of that for this. If you want to go to the next slide, yes. So a lot of people care about housing and tracking housing, but about 13% of your tenants are actually businesses. And there's other kinds of demand that a Walmart could signify if it's opening up in the area, right? So actually understanding and tracking all the new commercial developments coming into the area can be really helpful to understand storage demand. And then I work with a lot of development groups that basically say, wherever Home Depot goes, I'm going. Wherever Walmart's going, I'm going. And whether they do that on the front end or they verify that under, due diligence, right? There's a lot of, growth and jobs and economic benefits that commercial developments have on a market. Last one here is traffic counts. It's pretty obvious, right? If you have a lot of frontage and visibility, and you have if you have 40,000 cars driving by your facility a day, that's 40,000 free potential advertising opportunities that you don't have to pay for. Maybe you can pay for it in the form of new signage or better lighting or things like that. But almost 28% of customers actually learn about a facility just driving. So, being on in a location with a lot of good visibility, super important. And then 57% of customers rent from the first facility they contact. And which facility are they more likely to contact? The one that they see every day in person, or potentially the one that they see online first when they're searching. So understanding visibility and access is super critical to considering what storage properties you want to buy. And then even understanding this from an operational perspective, if you tell Peter, hey, we've got 50,000 cars a day, let's blow this up with signage, right? That's helpful, and you can actually make some operational decisions there too.
Quick question before we move on. How many data sources are you guys tracking at Tract IQ?
We have over 200 data sets within Tract IQ. So, not just storage, not just these demand drivers, but demographics, the traffic counts, all these kinds of things, have it in one place. So you can very quickly understand if a facility makes sense, or you can actually target properly.
Awesome. All right. Close
Nathan,
out.
I think I think that was prospecting, and I think Nathan, this is your section on what are we seeing in cap rates.
Yeah, no, I appreciate that, and I guess to go back, you don't have to move slides, but I mean, to let you into my world, and similar if you're a buyer or a seller, I think the hardest part of our underwriting and our process is this comment on rates. Okay, what are the asking rates? What are the achieved rates? What are the comps asking and achieved rates? A lot of that data, you may have some of it, you may not have all of it. So I think it's always been part of the trickiest part. I think a lot of people just say we're grabbing someone's P&L and slap a 6.5 cap on it because it sounds good. But I mean, the real tough part about pricing, whether it's for a seller to really see where we can push and what the true value is, or if you're a buyer, is really understanding the rate and, okay, what is it today and what was it a year ago, and can it get to X 10, 12 months down the road, or is it going to be hard to get there because of everything else in the market? So I think that slide that Noah hit on and that just clump of data is probably the most important, and always the most challenging to really understand value, both now and future value of a facility. I'll talk about cap rates, but I think the biggest part of trying to underwrite any property, or people on my team, or advising buyers, is really trying to understand the rates, which has probably never been more challenging than it is now.
I'll piggyback on that really quick, because
Yeah.
you mentioned just throw a 6.5 cap on the NOI and call it a day. If the seller does not have a management company, does not flow any expenses through that Peter and White Label would have to make sure they can manage the property in the way that hits your goals, right? Underwriting is a lot more nuanced. You have to really understand the full picture, and that's been really hard to do in storage the last 3 years, but hopefully we're turning a corner here.
Yeah, to that point, and as we talked about this slide, I mean, cap rates are so subjective for, I think, what he alluded to a little bit. You could have 10 different buyers or 5 different brokers.
Cap rate?
Yeah, it's like so subjective, and a seller's cap rate's different than, I'm sure every webinar for the last 10 years has talked about this, but a seller's cap rate's different than a broker's cap rate, which is different than 5 buyers and what their cap rates are. Many sellers don't have the overhead that a bigger buyer, or not necessarily a bigger buyer, but a buyer who's going to be using White Label, Extra Space, CubeSmart, or investing in Tract IQ, things that are huge value add, but a lot of these sellers may not have that. So there's so many layers there that affect things, versus what is a cap rate. But obviously it comes up a lot, and it is a driving force. You hear all types of, how do we value this? My neighbor sold for X per square foot, or how come you can only sell it for X per square foot when it costs this much per square foot to build? At the end of the day, good or bad, cap rates are what drive value, and more times for our industry and sellers, that's a good thing. That valuation outlook is I think what drives prices, and has and continues to, I think, in a positive way, drive values. And when are cap rates going to move, and how have they moved? We'll stay on this slide for a second. One of the other slides talks about where I think average cap rates are for different types of properties and markets, but so much in my world, or in my opinion, I mean, cap rates don't move as quickly as anyone thinks. They don't follow the Fed decisions. That obviously is a piece to it all, but they always lag interest rates. They always lag bank debt. But I think one of the most common metrics the cap rates may fall over time is the 10-year treasury, and that's what this slide is. This slide is not saying that we're at 4% cap rates today. I wish we were, but this is the 10-year treasury slide. And why this one's being outlined is many banks for permanent financing will go off of the 5-year, the 10-year, the SOFR. I think most commonly the 10-year if it's a more stabilized deal, longer term financing options. And regardless of what the Fed does at their next meeting, if assuming they cut it 25% again, or if they don't do anything, or if they surprise everyone and cut it 200 basis points, which won't happen, cap rates don't necessarily just follow that. They're gonna sway up or down based on what lending does, which drags. So I think this slide's an important piece to look at. We've been sort of stuck at that 4 to 4.25 range for a while, and it made it so cap rates stopped going up, in my opinion. And regardless of the Fed cut last month, the 100 basis point cut we got a year ago, we really haven't seen them push down. A lot of that's because markets react. Treasuries and bonds and where banks lend off of, they don't necessarily always react positively. So a lot of the lending is based on the 10-year for many borrowers, and this slide sort of outlines where we've sort of been stuck in that low 4 range. Now in the last 2 days we have gone below 4. In the last 24 hours it's been consistently at 3.9 in some change, so maybe we're moving in the right direction. But point is, until we see, in my opinion, the 10-year like consistently get mid 3s, for an example, or some like noticeably change that we've been in for the last year, I don't think we're gonna, in my opinion, really see cap rates move. I don't think we're gonna really see that compression that everyone's been waiting for and hoping to see since cap rates started going up a few years ago. So this is just a slide that outlines just where the 10-year's been, and the comment at the bottom is even when the Fed cut 100 basis points across 3 meetings last year, cap rates actually went up slightly because the market reacted negatively. Treasuries, bonds went up, and because of that, lending went up. So cap rates will follow lending more so than just what the Fed does and the federal funds rate, and a lot of it's just market reaction and market speaking. So I thought that was a just good perspective to have, because not critically, even when the Fed drops 25 basis points and when they do next, we'll get calls from sellers saying, hey, my deal that you thought was a 6.5 cap, is it now a 6.25? Unfortunately, it doesn't work that way. So it's a good way to sort of understand what ultimately affects cap rates. If you want to go to the next slide.
I'll even just quickly add,
Yeah.
Nathan, that the cap rates, or at least the last slide on how treasuries have moved, right? Cap rates are one part of value. The other part is your revenue and the actual performance of the store. So if rates are coming down, hopefully that unlocks the housing situation in the country that leads to more storage demand. So even if cap rates aren't necessarily going to change because of a 1/4 point change or a 75 basis point change, if that unlocks the housing market, that's still really positive for value.
Absolutely.
Yeah, I mean, you can agree on a price, which is one piece of the cap rate formula, but you underwrite your future income. That's why everybody varies across the map. It's your management, it's the market, it's everything else. You have to underwrite based on some agreed upon or projected income.
Yeah, exactly. And one thing you can control as an owner, more so than, you can't control cap rates or what the market does, market conditions, but you can control to an extent, easier said than done, but you can control what your performance, your operations, in theory, you can control your output, your income, where you can't control what the cap rates do in the market. So in terms of like how to add value, obviously you can hope that the environment gets healthier and gets to some level that it was a few years ago, but obviously that's out of everyone's control. I think this is a good snapshot. I'd say most of the people on this call are probably somewhere in the class B and C and secondary and tertiary market. Not that people don't own properties in large market or class A sites, but they're in our world right now. There's just so little opportunity. If we talked about how many properties are actually listed, that top left corner, there's just such a small even opportunity, even off market or on market make an offer on a primary market Class A, and a lot of those just for some just don't make any sense for owners to sell. A lot of these are institutional deals that maybe just got built over the last few years, and there's not distress, which is on a macro level, which is good for our industry. But point is, there's just very little sample size. I mean, even that top left box of that cap rate range, there's just so little sample size to go off of in the past year of what's truly sold from a primary market Class A perspective. And I think more relevant for many on this call is probably that every other box outside of the very top left. And I think this is a pretty good snapshot of what you can expect either from an owner or buyer perspective. Again, there's many ways to look at cap rate, but when it terms to like what's a true cap rate with true operating expenses, like where the values can get pushed to even today, I think this is a good outlook. And you might look at this and be like, how does anyone buy right now? I mean, even though lending is maybe a little more favorable than it was 6-9 months ago. I mean, most of these boxes on this chart would mean you're negatively levered going in, which is true, and sort of outlines why it's so hard to sell, or excuse me, to buy right now. Because even if you do everything outlined and have the perfect territory, at the end of the day, what's actually trading and from a market perspective is probably along these cap rates, which a lot of times you're not making any money right away. And where deals make sense is if there's upside, and if not only you believe it, but you can sell partners and investors and bankers that there is upside, where maybe you're buying at a 6.1 cap rate today on a 6.25, 6.3 mortgage, but this can truly get to a 7 cap in 2 years and a 9 cap. So that's where storage is different than other asset classes. But I think this slide outlines a good test, sort of snapshot of where the market is from a true cap rate, but also outlines, not even a positive way for many people on this call, why it's so hard to even make sense of buying and how hard it is to buy right now when you look at where cap rates are still trading at compared to where debt is.
Yeah, and being cognizant of time here, because I know I can sort of summarize what I'm going to go through quickly at the end, but
I sort of alluded to it a little bit. Yeah, I think we've sort of been stuck in this cap rate range for a while. I think until we see like the 10-year consistently in a much lower range, I don't think, if you looked at that last, I don't think we can expect short-term changes there. I think to consistently see cap rates compress 25, 50 basis points, I think we're gonna have to see treasuries, not just Fed decisions, and that's a step in the right direction, but treasuries consistently be in that low to mid 3 range for that last slide to really see noticeable changes, in my opinion, from what market cap rates are.
So moral of the story on the cap rate piece is don't expect these near-term cuts to have immediate impact on cap rates. Treasury's got to stay somewhere over the longer term, and certainly shouldn't be buying an asset where the only way to profitability is cap rate compression. You need to
correct. Yeah, and people didn't
upside, whether it's operational performance. I also wouldn't bank on like the market. Like don't negatively lever your asset unless there's a clear path or operating executional strategy to get there. Whether lease up new units, expense reduction. How are you going to find that income?
Exactly. I think to this day, the best pitch decks I see are conservatively underwriting, not so conservative that they're not even going to be in the running, but like realistic underwriting on taxes, insurance, realistic revenue growth versus like, hey, we're just going to pop rates 10% every year, which once you own many facilities, you realize that's harder to do. And then on like the exit side, like, yeah, you may be buying it at 6.1 and maybe you're penciling a 5-year exit at a 6 cap, which people hope it's going to be better than that. But I think the best sort of outlooks and analysis and decks I see, I think are just realistic in the outcome, and don't bank on market conditions drastically improving as the only way a deal pencils or makes sense.
Tell us about trends.
So maybe not exactly what everyone wants to hear, but I think it's just as competitive, if not more, than even when the market was at its peak. Call it 4 years ago, from a low interest rate, low cap rate perspective. It was hard to buy then, but in my opinion, I think you have just as many buyers, if not more, who've come into the industry the last couple of years that are still actively buying. Doesn't mean everyone's as active or as aggressive, but I think a lot of those buyers like storage and want to buy more, and so the buyer pool is as robust, and that includes public REITs, that includes large buyers all the way down to maybe would know about his first site and is looking to grow and buy number 2, 3, 4, 5. So the market has certainly gotten more competitive because with pricing changes, there's just less sellable deals, regardless of how many listings there are right now. I think there's just probably half as like sellable deals. That's not a very qualitative answer, but probably half as like real sellable deals on the market now than in the peak of the market when it made a lot more sense from a number standpoint for people selling. So everything's tighter. So that sort of has created two things. It makes it just as important to do everything we talked about, to really have a game plan and really hone in on a specific market, not stretch yourself thin, hone in on the underwriting, how you're going to actually operate these, whether you're hiring white label, what kind of data you're going to go off of. But it sort of made everything more competitive. And then from a macro storage investment world, these larger groups have shifted to quality in larger markets. So maybe that means there's an opportunity for a group who's more comfortable with a tertiary or smaller market, or if it's maybe closer to assets they own or closer to home, that might be an opportunity for you compared to 4 years ago when the market just got so frothy that even public REITs to some extent or large private groups were going into pretty smaller assets, relatively speaking, or smaller markets. That I think we've seen a little bit of a shift to bigger markets and quality from some of the bigger groups, which again maybe creates an opportunity for some others.
So there's been a flight to quality. Find Class C assets in tertiary markets if you want to find yield. Classic. The tale as old as time.
Exactly.
All right, here with some notes on diligence.
Yeah, a lot of this is obvious, but I think sometimes it does get missed, like with how competitive and tight the market is. I think people do try to take shortcuts to try to squeeze the numbers a little bit, and I think a lot of the bullet points in this slides just go back to just like have a thesis, market wise, property wise, and then have like just must-haves that you're going to do, just like you were if you're going to be buying a house and all that, and don't take shortcuts. And it may be frustrating because it may lead to what a lot of you maybe have done the last year. You underwrite 100 deals or look at 100 deals to find 5 that make sense, and then you get beat out on price on all. But I think in time you keep those processes in place, and you will make sure you're not cutting corners where you're going to get squeezed or get into a bad deal. At the end of the day, real estate investing means taking risks, and you might have to pull some aggressive levers, but stick to the X's and O's on all your due diligence. Do property visits, of course, hire like legit third-party inspections, and just stick to the basics. I think is what the sort of the common theme of this slide is.
Perfect. All right, we have 5 minutes left. I'm sure we could probably go over a little bit for questions. So I mean, the core focus of what I want to talk about, and it ties all the way back to the beginning, which is, so you're a good investor, so you have a strategy for buying an asset. What is your philosophy? What are you prepared to do once you own the asset from an operations standpoint? Being a good investor does not make you qualified to determine if your call center does a good job or qualified to measure marketing performance. So moving on to the next slide here, just to kind of highlight this, it may be that you have a dedicated resource and a person and a strategy that is going to lend itself to self-management. And you can do a bet, like if you can focus on a couple of assets, and if you have economies of scale, then self-management makes sense. This is not me saying use a third-party manager or don't. My point is, once you own an asset, you are both an investor, you're definitely an investor, but then your choice is, are you going to be an operator? Are you in the services business? Noah and Nathan are in services business, and they are experts at their craft. Noah has got better data than anybody, and as a result, he's focused on building out the right infrastructure, figuring out where the market's going. That does not mean that he has a call center that can convert people into renting storage customers. But he's aware of the different levers within his portfolio and leaders that he needs to actually do a good job on these workflows. So, going to the next slide here is really figure out what your strategy is. Are you buying big deals or small deals? Are you buying a bunch of deals, or are you buying only one or two? Based on that, you need to figure out how you're going to perform the work that needs to happen at a facility. And you need the right KPIs and the right ways to measure how you're doing a good job. So just moving on quickly here. If you are going to be in the self-storage operations business, it means you need to make educated choices on your technology stack. What sort of FMS are you using? What sort of website are you using? Access control. How are you going to do auctions? Are they legal or not? Is there a way to automate it? For facilities maintenance, how are you set up there? Is it just going to be one guy at a facility mowing the lawn, also answering the phones, also doing the rate management? Can you outsource a piece of it? These are choices you need to make. And then once you make those choices, running through this whole list, I'm not going to go through each of them. Each of these functions is something that has its own corresponding metrics that measure success. Noah and Nathan just spent 30 minutes talking about one single metric, which is a cap rate. And that's not the only metric that matters in storage at the asset level. It's NOI, it's conversion rate, it's your expense ratio. All of these things are things you can focus on, and every single one of these workflows has its own metrics and KPIs that you should be measuring to see how you're doing there. So just going deep into marketing, most of the folks here on this call, I would imagine, haven't heard of the concept of customer lifetime value to CAC, right? It's like at every single tenant, your marketing team should be studying how much value are you extracting out of the marketing spend that you're investing on those tenants. If you're not familiar with that concept, then you probably should have someone handling the marketing function at your storage facility that does know that concept and can report on how they're performing against it. So if you are in the services business, just understand that you need to map out all of the workflows associated with self-storage management, and you need a set of KPIs to tell you if you're doing a good job and a set of inputs related to actually executing those workflows. Otherwise, it's a hope and a prayer, and you're in the operations business, but you're out over your skis. So got final slide. There's one more slide here. This is the KPIs. Then we can run past this because we're now at 3:00 and then get to questions. Why don't we see if there are questions while I just get into these? There seems to be so many lease-up deals that get to 80% physical occupancy, no problem, but economic lags behind at 30 to 50%. No sign of getting to 70, 85% economic occupancy. I don't see this getting better anytime soon. That's sort of a commentary on the market by Sam here. Noah and Nathan, do you have any data sets to point otherwise to this metric? I think
you hit it on the head. It just shows where in a lot of markets we are oversupplied, and we'll get better from here. I think some should and will, some won't. If you're buying a facility or if you're an owner, you really got to understand the saturation, the supply, and how that will affect what you're trying to do. And maybe I might bought this facility from this person I thought was a mom and pop owner, but turns out it's harder to raise rents to a certain level because of the fact that there's 12 square feet per capita, and 3 of those are REIT managed deals that not only are in lease up, but will be in lease up with low rates for 3 years. So I think it's just a point of really diving into that piece of it on the acquisition side or market research side.
Yeah. And go ahead, Noah.
I'll add quickly for Sam's benefit, right? We track all the street and web rates. The street and web rates delta right now, as of the end of September that we're tracking, was about 23%, which is up from 10% late 2023, and it changes very quickly. But what you're getting at here is web rates have fallen drastically in the last number of years relative to the street rate. So you kind of have to ask yourself, is the street rate in this scenario, right, that you have here, where you're moving in people at the web rate that's really low, is your street rate actually based on market data, or is it not, right? And I think web rates have rightfully taken a lot more focus from investors and operators, because those are the rates that people are actually moving in at.
Yeah. And look, you can't control the market. you can control what you do once you own the asset. So I guess that is a good way to close this thing out. And we can go for a couple of minutes for those that are still on, because it looks like we still got 40 some odd people or 30 some odd people on here. But, expense ratio, where can you eliminate expenses? How can you measure performance of your individual workflows? Are there opportunities with technology to eliminate costs? That's another way to get, to improve an exit cap rate, is to just reduce expense ratio and do it in a way that's credible, where a buyer might assume the same expense load on the back end. I'm curious, Noah, on that one point you made. You were at 10%, we're now at 23. How much of that have you controlled for, like, people becoming more sophisticated and introducing the web rate discount? Like, is it just more are doing it now, and therefore you've gone from 10 to 23%, but when they do it, the discount is 20%, is 50%? Like, where have the REITs adjusted their discounts?
Yeah, I was on a panel a couple weeks ago about the future of self-storage, and we were reflecting back about how much self-storage has changed in the last 5 years. And one of the big unlocks has been the institutionalization of management, right? White label is a perfect example of that, and all the growth that you've had, bringing institutional quality management to the rest of the industry. So as we saw storage demand fall over the last 3 years, we saw a huge inversion between street and achieve rates, and we saw web rates now becoming super discounted versus the street rates. That's all kind of been a race to the bottom, where unfortunately it seems to me that has been a lot more, that strategy has been adopted across the board. Because if you're managing a facility, Peter, and down the road Public Storage says that their first month is free and the 10 by 10 that you can move in is $60, it's hard for you not to want to do the same thing, because they're going to get that lead. So it's, to me, transparency in the industry is definitely, like, needed. And I think we're starting to see that, but definitely I think this scenario that Sam is talking about is a lot more frequent today than it was 5 to 10 years ago.
Yeah, makes sense. Yeah, I mean, the street, right? That's kind of the major topic. It's the elephant in the room at every single conference we've attended, and everybody's wondering where that's going. Hopefully, it doesn't result in some sort of rent control or regulation, which has been on many of the dockets recently, probably as a result of the. Well,
there was passing in California of a watered down rent control bill recently, where it started off as pretty punitive, and now it really just became more of a disclosure kind of concept with your customer, which is a positive, but very much an indication that if the industry does not respond and does not change the way that we think about pricing, then we might not have that choice. We might have it made for us, and that's probably the worst outcome.
Exactly. Yeah. I mean, it's a tricky consumer strategy. That is, at the end of the day, you are obfuscating the rate that the customer is going to pay. It's like going to a car dealership. The price you see is the one you get for the car without tires. That's the storage, the web rate. Well, cool. Yeah, this has been, we're starting to lose people here. We'll send this recording out. Guys, thanks for joining the call today. Appreciate it. I think this is, it's well studied, each of the aspects that you guys have focused on. Just quickly, Noah, can you tell everybody how they can find you and the Tract IQ product? I think that'd be helpful.
Sure. Yeah, no, this was awesome. Peter and Nathan, really enjoyed the conversation and excited to continue all the dialogue behind the scenes. You can find me on LinkedIn, Noah Starr, and I post a lot of data and share a lot of resources. And then you can come talk to us at tractiq.com. We have a lot of free resources in terms of data. The Almanac's coming soon, and we're providing the data for that. So there's a lot that we love to do to help investors, brokers, and operators. So awesome. Really appreciate being here.
Yeah, thanks for leading the thing, Nathan.
Yeah, likewise, Peter and Noah, thanks for having me. And I thought it was great dialogue and a lot of the things that seem obvious, but I mean, to this day, I think we need to continue, myself and my team, understanding and diving into everything we talked about, because the market's ever changing and it's robust. And at the end of the day, we do work in a great industry with great people that are happy to share and help each other out. So similarly, and us as brokers, we do have so much data on what rents and supply and sales look like in any given market. So always reach out, even if it's, hey, I'm not going to offer on anything you guys have. We're always happy to help with what we know and help wherever we can. But yeah, thanks again for having me.
Yeah, thanks for joining. And you can find us at whitelabelstorage.com. We're going to post these slides and this content. So for those that were not taking notes, don't worry. I'm sure it'll be on our LinkedIn. I bet Noah and Nathan will probably then have the opportunity to share it. So we'll cut it up and share it with the group broadly. Thanks, guys.
Awesome. Thanks so much, everyone. Have a great day.